Welcome back to the 13th grade. Today, let's talk about creating money or letting your money make you money. And that is, of course, by investing. Let's get to it. Okay, guys, thank you for joining me here at the 13th grade. Again, this is probably going to be one of the courses that or lessons that we're going to teach, which you're going to want to jump to just based on the heading or whatever we decide to label this as. I think I've said this in every single video thus far. It's extremely important that you don't just jump around. Of course, it is very enticing just to understand of like, yeah, I got to take my money, I got to put it in an investment. How do I do that? What should I be investing in? And then just to kind of come right to this video. But there's a lot of things that go into beyond just investing. To be quite honest with you, is if it was as simple as you just understanding that you need to take some portion of your money and put it into investments, and that those investments over time would end up earn or making you a lot of money. I wouldn't necessarily need to do this course. The fundamental purpose of this course is to help you understand that there are, 4 or 5 things that you're going to put together kind of strategically. Of course, we just went and talked about credit. Investment is the second one of that. But imagine if you didn't do the credit part, you didn't understand the credit when you go to do the investments. And if you end up getting a really high interest rate or you're unable to get the financing and using leverage to actually go do the investments or whatever, you would be, you'd be kind of just, out of luck, if you will. And that's the purpose. I've looked at so many webinars, so many different or seminars or courses or whatever, just attending different places. And a lot of the guys that are out there, a lot of the gurus will simply say to you, listen, you need to go do this. You need to go do this. And then, that person finds out, oh crap, I need $400,000 to do that, or a big lump sum to do that. Or I'm going to need to have really good credit in order to, like, for example, buy a duplex and then rent out the other side, right? And so again, all of these things fit together. It's about, how you create income, which we'll get into a little bit later. It's about, building credit that lenders will love. It's about investing those particular funds of the money that you've earned. And it's about doing those things with credit in mind. It is, in fact, the strategic combination of those things that is what can move you from nothing to something in a very short period of time. Any one of those things not done correct, not having good credit, investing in the wrong things, or investing and not even considering taxes will drastically rob you or extend your period of time of reaching FIRE, being financially independent. It just take a lot longer. So before we get into it, though, I want to remind you, I'm going to go ahead and throw up the disclosure because we're getting into the investment part. We are going to be going over a lot of things here over the next several lessons. Hopefully, I remember to put this disclosure up every single time. I cannot stress to you enough, just because I put something out there, we're recording this in 2025 now. Early 2025. A lot of this stuff was actually built back in 2019, although it still applies today. The purpose is, just because we go over an investment and this is a way that you can earn income, doesn't necessarily mean that you should be taking your life nest egg and then throwing it into it. Just because I'm talking about something doesn't necessarily mean that that investment or that opportunity is good for you. I'm not your CPA. I'm not your accountant. I'm not your financial advisor. And in fact, even though I'm teaching this course, I still rely on accountants and CPAs and financial advisors and sort of just mentorship from other people about what direction we should be going in. And again, every single day I consume a tremendous amount of information just to keep sort of my mind on what is happening in the economy. How's real estate doing? Is this a good time for real estate, or is this a good time for stocks, or is this a good time for crypto, or should we just kind of hold back and do nothing? You have to be constantly in it. Of course, me talking today, I don't know your situation. So please don't just listen to what I'm saying over the next several videos and then go, hey, I'm going to go jump into this. A lot of these things not done correctly means can mean you lose all your money. Okay. You are not going to have high reward without obviously having some risk there. And that is risk of losing your entire principal, meaning you put $10,000 into something, you could lose it all if you're not doing things correctly, which is why I always, with everything, even in my own business, follow that sort of, that typical rule of first you crawl, walk, then run into anything. You want to do some kind of investment, just dabble in a little bit. Let that do that for not just a little bit of time, but a couple of years, then dabble into the next one and then dabble into the next one and kind of slow roll into something so that you can get a gear from the industry. So without further ado, there's your disclosure. I'm not your CPA. I'm not your accountant. This is for educational purposes only. I'm not telling you to go invest in anything. So you've been warned, buyer beware. Buyer beware. So, but leads us into a very good topic. And so the idea here is diversification. And so there's several ways that you can actually diversify your particular portfolio. And when I say portfolio, what I mean is all the different things that you actually are investing in. Okay. And so you can diversify over the asset class itself, okay? And you can diversify within that particular asset class. So, what I'll break it down to you. Of course, there's probably other ones that are around here, but when I other investments that are probably available, and I'm not thinking of the main ones. The ones that I want you to concern yourself with are very simple: stocks and cryptocurrency. And when I say cryptocurrency, and I'm sorry for all those out there that, love the meme coins and all of that. While you can make money, I'm basically just mean Bitcoin. Okay. So stocks in Bitcoin, private business, real estate, and then debt. Okay. And so these are the ways, the primary ways that people and are sort of big chunk categories of the way that people invest their money to get the highest return on investment and probably the most benefit when it comes to taxes within stocks, within private business, within real estate. You want to diversify within those particular channels. So, an example of that is I wouldn't, if I say had, $100,000 and I was going to go buy stock, I wouldn't just go buy one particular stock. I wouldn't just go buy like, oh, let me just go buy Tesla and let me ride it because I really like the company. Diversification means you're probably going to buy a bunch of different stocks, and with those stocks over multiple classes and or industries. And what I'll say to you is what most people will tell you is if you're going to do stocks, just buy an index fund like an S&P index fund, which is going to be basically just be a bucket of a bunch of the sort of the top performing stocks in the market anyway. So good way to go. The other one is, private business. So if I'm going to do a business, I might be in the restaurant industry, but I might decide over time that I don't want to just be in the restaurant industry. I might want to do something else. Like maybe I buy I don't know, some kind of, I don't know, daycare system or whatever, just something completely different. One is restaurants, one might be leisure. It could be completely different. Insurance company would be a good example of that. Real estate. And real estate is interesting because we like to purchase real estate, not necessarily just within a particular class. Like we're going to buy residential. You could buy commercial. Those are two different industries. Residential, about it, single family home, so forth. Commercial, you're talking about like retail space, owning like a McDonald's building and they're renting two McDonald's or a shopping plaza or something like that. So commercial and and residential. Then within the residential space, let's say you just decided to do that, you might go, well, I want to do single family homes, but I want to just do single family homes. I want to do single family homes and probably multifamily. Multifamily would be like a duplex, a triplex. I mean, technically those are still single family, but like say an apartment complex, maybe you get like an eightplex or something like that, or a 12plex, something like that. You don't want to just do all residential. You might want to do residential, or I'm sorry, single family and also multifamily, right? And then within those, you might want to do single family homes. You might want to do townhomes. You might want to do condos. I would also say to you that you probably want to do even different geographical locations. If I said, hey, I'm going to buy all my properties in this town in this state. Well, if something happens to that particular town in that particular state, and we've seen it, your entire portfolio could be at jeopardy. Right now, there's actually major wildfires that are happening in California. Imagine if all your properties were in California and sort of that fire zone. That would be a bad day. Imagine if all your properties were, say, in Orlando, Florida, around Disney World, because you thought that was a good investment because people are going to go travel to Disney and they'll always rent, right? Short-term rentals. Well, that could be a problem if a hurricane comes through and wipes out all your property. So we like to put properties again in different categories, both residential and commercial, and then like within residential, both single family and multifamily, and then from there in different cities and different towns and in different states. Okay, so super diversified. So a great portfolio that we would really want to look at is to say we have a certain portion of our stuff in stocks, we have a certain portion of our income in cryptocurrency, we may have a private business, maybe two, probably in two different industries, and then real estate we have those different real estate options that I'm talking about. In addition to that, you have this thing called debt. And debt basically means is that you're taking your money and just lending it out. For the most part, you're going to want to go through a company to do that. I don't necessarily suggest doing private lending at the start, but if you were going to be lending out, a great way to do that is to go to a company and let that company break up whatever money that you're investing into several different types of loans over several different people, and then send those out to whomever's borrowing the money to get your return on investment. So again, diversification, diversification, diversification. It is extremely important because it allows you to reduce risk. It 100% might mean that you're not going to get the highest return on investment. Trust me. Let's just use the big elephant in the room, Bitcoin, for example. If you've been following Bitcoin, for the last 5 years, like I have, it can be really hard watching an asset go from, say, $2,000 a coin all the way up to, as we stand here today, $100,000 a coin, and to make that type of growth and that type of return on investment, and not want to just take all of your millions of dollars and put it in Bitcoin. However, what goes up can come down, and things can change. Everything looks like a great investment 2020 and everything in the rears, right? However, there's obviously people that go in, put all in, and lose absolutely everything. Even in stocks, think of some of the big ones out there. Enron, right? If everyone lost their money, a lot of people had all of their funds in that particular stock, including their pension, because they thought the company was great and they lost all of their savings. So diversification is going to reduce your risk, and it's going to ensure that you preserve your capital. Even though you're not getting the highest return on investment, it's going to make sure that you preserve your capital. And what we like to do is we might say, well, if we're going to be diversified, we might want to give a little bit more money over here because we think that's a higher return on investment, but we're still allocating a little bit to everything, right? And then again, within those particular assets, you might want to go to the highest return investment and make sure that just that one sector is performing. I'm going through a lot of information. Don't worry about it. Trying to go fast for the sake of the video, not being too long. We'll get into a lot more of it in the detailed breakout videos after this. What I'll say to you now, just talking to you about diversification, 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 right? So hard. What I want you to do is to grow to that. All right. There's a completely different idea and a completely different mindset that is to take all of your eggs. They always say don't put all your eggs in one basket, right? Well, the idea is put all your eggs in one basket, but to watch it very, very closely. Okay. And so there is a rule of thought out there that says, listen, if I go invest in real estate, if I go invest in crypto as well, and I'm doing loans, I'm investing in debt, and I'm doing buying dumb businesses and so forth, and I'm doing all these different things. My attention is going to be some in real estate, some in the stock market. Like I'm going to want to pay attention, especially seems when some of those values get up pretty high, right? And so there are some people that are out there that are wildly successful, that kind of just say, you know what, I'm not going to do that. I'm not going to diversify. I'm going to take all my assets and I'm only going to do just dividend stocks or just real estate. And I'm only going to do this type of real estate. And they just focus on that one thing and they perfect that one thing. And they just feel good about it because they can kind of research everything that's going on that would affect their particular investment, like the industry, the economy, whatever it is. And so they feel really, really great about just putting everything into one basket. As we will do all the time on this channel, I'm going to give you both sides of everything. Okay. There are tremendous amount of gurus out there that think they know everything. To be honest with you, the only way we know what's right for you is for you to decide what's right for you. We are going to talk heavily about going through, the Grant Cardone method. We call that the debt flow method. If you've actually looked down below, you might have seen it on some of the slides, which is taking out lots of debt to get great cash flow, debt flow. Okay. Or you might want to go for the Dave Ramsey method, which is just not taking any debt and just kind of putting money in investments and just kind of keeping it simple, right? Which one is best for you depends on your risk tolerance, depends on how much money you're coming in, depends on where you are in your life, depends on how much time you can attend to it. We're going to give you both options, and then you can decide. And the same thing with the diversification. Listen, you might say, like, you know what? I don't want to diversify. I want to put all my eggs in one basket and I'll watch it closely. It's completely up to you. My recommendation is with all the people, a lot of people will tell you is to diversify because it has lower risk. But I understand the argument of someone saying, you know what? It's less risky for me to have everything into one. Now, with that said, what I will say to you, which is oftentimes the case, is when you're first getting started, you're not necessarily going to be diversified. Okay. And so let's say you decided to go, I'm going to go, I'm going to buy real estate. I listen to Elliot and, real estate makes sense to me. And I understand, buy a home. I like the idea of owning an asset and, I can just rent it out to somebody and it seems very stable. And as long as I have, the monthly backup of mortgages or whatever, I feel pretty good about that. So I'm going to do in real estate. Well, it can take you a significant amount of money to put that in real estate. And once you get one property, to be honest with you, one property is not going to change your world. You really kind of need three or four or five properties to really get a nice little cash flow coming. And so you might say to yourself, listen, from 25 to 35, I'm just going to focus on really building out my real estate portfolio, and I'm not going to mess with any of the other stuff. So you may be all eggs in one basket for a certain period of time. And then you might get to a certain point where you're like, man, I got a lot of real estate. I got 10, 15 properties. I wonder, I should probably diversify. Let me try to do something else just in case. Let me use this cash flow that I'm receiving from these particular assets. And let me go and start putting some of that into a stock market. Let me start putting some of that into like a business or something. Let me start to diversify as your real estate portfolio gets bigger. So you can again make the decision to be sort of all eggs in one basket early on. And then the idea is to then diversify as you get larger and larger and larger. Perfectly acceptable. And to be honest, that's exactly what we did. So the first I want to talk to you about is the stocks, so stock market. And I think this is probably the easiest for most people to understand. Most people have heard of the stock market. This is probably the easiest thing for people to get their mind around because you've heard it so many times. Just it's very simple. I do want you to understand what the stock market is and what it is not. So, unless you're going to put a tremendous amount of money into stock where you're going to get a significant ownership in that particular company, so you have $100 million, $200 million to put out there, you don't technically own the stock. Okay. And I know for some of you guys that are out there, like, no, technically you own a share of stock. So that share of stock gives you some sort of voter rights, blah, 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 blah. Listen, you could take your stock, okay, that you buy some stock, you could take it up to the company and be like, I own 10 shares of Tesla. And they're going to be like, yeah, great. So do you. And I got a trillion other people, right? It's not going to do you anything, right? When you're trading in stock, the easiest way that I can explain it to you is you're buying a receipt, a ticket, basically. And you're basically saying, is I'm buying a little bit of Tesla. And if Tesla makes more money, all right, that doesn't mean you're necessarily going to get money back from Tesla because you own the company. What that means is if I own stock in Tesla and Tesla increases 200% in revenue and in net profit over several years, the idea is that somebody else is going to want to buy that piece of that certificate from you, that stock from you, because the company went up. It's that simple. If it sounds a little bit like gambling, um, I'll be honest with you, it is. It is a little bit like And so how do people understand, like, how do you know, like, what stock should I buy? How much is going to go up and so forth? Not to get too complicated, but I want you to kind of understand some of the basis here is that if I buy a stock and the company projects that it's going to grow 20% a year, somebody will buy that stock and they'll buy it based on the projected increase in revenue. Oh, it's going to go up 20%. I'm willing to pay X amount for that increase. If a company says, I'm going to go up 60%, somebody might buy that stock because they think, hey, the stock's going to go up 60%, and that's a high growth stock. So I'm willing to pay more for that particular. When we buy stocks, usually you purchase things based on earnings per share, right? And so I might say, if I'm going to buy Ford trades at a $3 earnings per share. Means for every share that's out there, their earnings is $3. So if I took all the shares times three, that would match their earnings. But you might go to Tesla and go, well, if Ford is traveling is trading at $3 per share, then Tesla should be also trading at $3 per share. So if Tesla's revenue is more than Ford's, then that means Tesla should be more, right? Or if Tesla is making less money or is not even profitable, let's say they're negative earnings per share, then they should be trading at a less amount per share than Ford. Not necessarily, because Ford might not really be growing at all. And Ford's kind of like it's always been there, it's always been around, it's not really growing. They do a little bit of increases every year, they sell a little bit more cars, but there's nothing really crazy going on with it. Tesla, for example, might be losing money right now, but the prospect of owning Tesla over the course of 10 years might be, well, they're losing money now, but 5 years down the road, it could be earning 40 earnings per share or $40 earnings per share, right? And so somebody might say, well, I'm going to pay not $3, but I'm going to pay $200 per share. And that might not make sense to you because you're like, how's one company losing money, but their stock is more expensive than the company is making money? Because the prospect or the idea that it is going to be better in the future makes that trade at a higher value. Because the idea is that it's going to eventually catch up to Ford and then it's going to be 5, 6, 10, 15 times higher than Ford or the market cap or the revenue in the future. So people are trading on future sort of earnings. Hopefully that makes sense. And that's why sometimes you can actually have big waves in the stock market when somebody might come on the economy and be like, hey, we think the economy is going to be slower. So then people sell because they think companies are going to slow. They're not going to grow as much. And so the people start to sell the stocks because they say in the future, we don't think Apple's going to make money because whatever. So so the idea is when you're buying stock, yes, you're buying in the growth of the company, right? You're not really getting a piece of the company that you can do anything with. You don't have any shares of the company to where you can go vote or you're going to earn money necessarily from the company. You're kind of just buying it with the idea that hopefully the company goes up in value. And or it makes more revenue. And if they do make more revenue, then hopefully that piece of paper that you bought will be worth more in the future. It's that simple. And it would be no different than me buying this cup, for example, for $4 and keeping it for 30 years. And then because this cup is now an antique, it is now worth $50. And so I bought something, it went up in value because of time, and I made a good judgment, and that's what it is. Real estate's like that. Most investments are like that. You're buying it with the idea that eventually it's going to be a more value. Stocks, again, are just a little bit trickier because sometimes they trade higher simply because they trade higher because the CEO made a speech somewhere, because whatever. It doesn't really necessarily matter. Sometimes they trade higher, sometimes they don't follow the same formula. So when you're trading stocks, you actually have to know that particular stock, that particular industry, and how that particular stock trades. So something might trade at a higher multiple or higher earnings per share or higher multiple to the earnings per share. And it just is what it is. And nothing else in the sector might be like that. So a great example of that for those of you who are, probably at the time of 2005 would have been 25 to 65. You probably have heard of GameStop. And GameStop is one of those things that GameStop's never really earned any money. But somebody identified GameStop and they got a bunch of people to buy it. And because they bought it, it went up. And then because it went up, people bought it and it went up because people went on it. And it just kind of cycled up and cycled up for no other reason. Again, kind of a little bit of gambling. Some people will tell you, well, GameStop is a meme stock and people are just gambling with that. Guys, you're gambling with Tesla, you're gambling with Apple, you're gambling with all of them because ultimately you are not the person that's on the board of directors. You're not the person calling the shots. And at any moment, election, a new politician can come in, a CEO can pass away, or just something might get in favor for whatever particular reason, and the stock can take off. And it doesn't. It's a little bit of gambling. So within stock, what we generally say to you is a recommendation, especially early on. Like if you're 25, you just got a job, take your money, throw it into an index fund. What an index fund is basically a bucket of stocks. Well, like an S&P index fund, S&P 500, an index fund tracks the top 500 stocks, the largest stocks. And the idea there is what's in S&P 500 are the stocks that are gaining the most, they're growing the most, they're the largest companies. So I'm just going to invest in a little bit of every single one of them. I invest in this index fund. We'll leave it at there. We're not going to get it too much more into it because I don't want you to get into the weeds of that. This is a great thing as you start to investing is that you actually search out a certified financial planner or an advisor or someone else to help you guide you in that particular, what you should or should not buy. For the most part, the idea there is you let it put in the index fund and then you leave it. Oh, I'll leave you one last thing. When you're buying stocks, and this is for my dividend guys out there, if you guys are all losing your mind going like, oh, you buy stock, you don't get any return on investment. Technically, there are some stocks out there that pay what's called a dividend. And the dividend is a little bit of money that they give you based on the profitability of that particular company and how many shares you own. It's like pennies. And the dividend guys out there, I swear, I see them on TikTok or Twitter and X or whatever all the time. And they're like, dividends are the best thing. And, if I get $100,000 in stock, these particular stocks that pay a dividend, I can extra 2 grand a month. I don't know. It's literally pennies. I don't focus on dividends. But there are some stocks that are out there that every quarter, every annually, they'll pay you a little bit of a dividend based on how many stocks you own. It's not that much. It is possible. So technically, there is a way to earn or to own a company through stock and then get a little bit of return on investment. But for the most part, I wouldn't focus on it. Now, when in investing in stocks, how would we do that, right? Besides the granular, what I just told you, how stocks kind of go up and down in a very crude way that people are probably going to hate on for. There are basically two different ways that people invest in stocks. Okay. The first way is through a retirement account. And this is what the average most people, 99% of people are necessarily going to do. Okay. And a retirement fund is basically just imagine it, and you don't have to be at a work, but usually when you join a job, they might have something called a 401k. And a 401k is basically a retirement plan that was developed or passed, I believe, by the government. I could be getting that wrong, but is an account that the government basically says to you, listen, if you take your money and you put it into this particular account and you leave it there for 65 years, we'll allow you to grow it tax free or we'll give you some kind of tax benefits. And we'll get to that. So there's a 401k, there's an IRA. And honestly, within those categories, there's like a number of different subcategories. We won't get into them. I want you to think about retirement stock, either with pre-tax investments or deferred taxes on those particular investments. All right. We'll get to more on that in a second. The second of there is something called direct stock. And direct stock, it just means you're not putting anything out of you're not putting a retirement account. So you're not necessarily getting deferred tax savings, which means maybe you got 10 grand, you go buy $10,000 worth of Tesla. It's in a taxable brokerage account. If Tesla went up to 20,000 and you sold it, you made a capital gains from 10,000 to 20,000, you made 10 grand. And so you're going to be taxed on that $10,000. Okay. And so that is a taxable account. If the same thing happened in a retirement account, those particular gains aren't necessarily taxed in that particular year. So if I put 10,000 in my IRA and I bought the same stock of, let's say, Tesla, and it went up 10,000, I sold it. If I did that within my retirement account, I'm going to pay zero taxes in that year. However, I'm going to pay some later on down the road. or not, depending. We'll get to that in a bit. So let me just show you a kind of example of that, the way that this would look as far as a 401k. And I kind of want to go to both of those just to kind of give you a little bit more. This is an example of typical 401k and what you would see if you sat down with your employer. Let's say you just graduated college, you just took your job, nice company, Google, and they say, hey, I got a 401k, you can contribute to it. It usually looks something like this. Okay. And as you'll notice, sort of the top bracket here, let's just say you're making $50,000 a year. If you were you have something called an employee contribution, and then you have an employer contribution. Okay. And what an employee contribution is just what it sounds. That means that let's say you make you make, in this case, $5,000 a month. You contribute 1% of your check each month to your particular retirement account, or $500. You've contributed $500. Your employer might have said, listen, for every dollar that you contribute, I'm going to contribute 50%. And I'll do that up until a certain amount. Okay. So a lot of times an employer might say, well, I'll do a 100% match up to the first 5% of your salary. It would be an example, which means if you put in 5% of your salary of $50,000, like in this chart here, your total amount that you'd be contributing would be $2,500. In this example, or in this slide, it says a 50% match, so it shows $1,250. But if your employer was doing a 100% match of 5%, then you would have contributed $2,500. Your employer would have contributed $2,500, and so you'd have a total of $5,000. So hopefully that makes sense. So an idea here, what kind of this it would be an example of, is what most people will tell you, financial people will tell you, is if your company owns a 401k or has a 401k and they do a match, okay, so they do 5% or 100% match, a 5%, 3%, whatever it is, most people will say at a minimum, you have to do whatever the percentage is that your employer matches. Okay. And so an example of that is, do you notice here in the slide that at let's say $50,000 a year, if I contribute 2%, I'm contributing 1,000. My employer match in this example is matching 50%. Okay, so $500. They're doing 50% of what I match. So the person made $1,500 is what they put into their IRA. Another way of looking at it, because their employer is matching them, they made $500 extra in income. Okay, this is gonna be important. And actually, we covered this. Remember, we were talking about like the different ways that you can do like the Grant Cardone method and the Dave Ramsey method. And we showed you the IRA contribution calculator, and we said if you put in $500, I think it was from 35 to 65? Was it 30 years? Maybe it was 25 to 35. I don't know. You can go back to the other videos and look at it. And we said if you do that for a certain period of time, you'll have $1 million. And we also talked about like if you're right now and you're making $50,000 a year, and I said to you, hey, I need you to contribute $1,000 a month or $500 extra a month. Many of you might be thinking, how the heck am I going to do that? Because I don't even have enough money. Well, this is kind of that, right? And so the idea is that the employer match is sort of free money, right? And so if you put in 1,000 to your retirement and your employer is going to match that, in this case, it's 50%. Most matches are 100%, whatever you put in. But like in this case, in this example, it's 50%. So you put in 1,000, they put in 500. Just think about if you did that every single month, they're giving you an extra $500 every single month. And let's say from whatever crazy reason, you just decide to stay with that company for 30 years or whatever. They would basically be funding $1 million for you. Like it's a tremendous gift. So normally the idea there is that you will always max out. You will always contribute at least what your employer is contributing. So again, in this example, 50,000 at 2% contribution, employee contribution, you're going to give 1,000, your employer is going to give 500. So you're putting 1,500 during your contribution. So let's jump to 5%. At 50,000, 5%, you're contributing 2,500, right? Your employer is doing 50%. They're contributing $1,250. So your total contribution is 3750. So you're making an extra $1,250 a year that's going directly to your retirement simply by just you contributing some as well. Now, but notice after $50,000, right? 6%, you contribute 3,000, your employer does 50%, 1250. Uh-oh. Wait a minute. Why is it 1250? Well, remember what I said to you is that what a lot of employers will do is they'll say, I will match you 100% up to 5% of your salary. Or I will match you, in this case, 50% up to 5%. So let's say you made $2 million a year, right? And you decided to contribute 100% of your income to your IRA. Well, your employer's not going to match you 50% of what you contributed, right? Doesn't make any sense. Of course, you can't do that. There's some regulations, like you can only contribute so much. I believe the total amount, and any good financial sort of talk person, which you can tell I'm not, would know this, but I believe the max 401k is 20,000 or 21,000, might be 25. It's somewhere around there. So you can't contribute more than that anyway. But the point is that if you're sitting down with your employer and they say, "Hey, I have a 401k, we're going to match you 50% up to 5%. Do you want to elect for that?" Yes. The only answer to that is yes, absolutely. I like free money because every time they give you money, you're getting an immediate return, basically an investment of at least that much. If you put money in the stock market and you get an 8% return, you would feel pretty good about that, right? In this particular case, you're putting in 1,000, you're getting 500, you're getting basically getting a 50% return year one. And most employers, again, are doing a 100% match. So you're getting like basically just doubling your money. That's a pretty nice big leg up, pretty nice benefit, which is why people like to choose jobs with healthcare and also 401ks. All right. Besides a 401k, let's say you go to a job and they don't offer a 401k because it's a small company. Maybe they can't do it for whatever particular reason. There's another account that you can contribute, and you can open this up by yourself, but it's called an IRA. All right. In an IRA, there's basically two types of IRAs. We're not going to get in the weeds here, but there's a traditional IRA and there's a Roth IRA. Which one that you can contribute to is directly connected with how much money you make. Okay. Again, I'm intentionally not giving you some of these things because I want you to go research that on your own. And I want you to talk to an advisor on your own when you start to decide to do some of these things to decide which one you want to do. The main thing that we're doing here is 10,000 feet up. I want you to understand that there's retirement accounts and you should be funding them. Okay. Traditional IRA basically means is that you get a tax deduction for your contributions. You pay no taxes until you take distributions. The Roth IRA says you're actually going to get taxed now, but you don't get taxed later. Okay. Now, so this is the first time that we're going to talk about investing in taxes, right? And this isn't even peanuts to what we're actually going to be talking about when we talk about investing in taxes. But it's our first way we can start to make some considerations, right? What this is basically saying is that if I made $100,000 a year, I'm going to be taxed at my tax, let's say 20% of 100,000. Let's say that's your tax bracket, 20% income tax. So I make 100,000, I'm going to pay $20,000 a year, right? On that 20%. So I'm only going to walk away with $80,000 because I paid 20,000 to the IRS. If I decide I'm going to contribute $5,000 to my traditional IRA, what that's saying is, well, I didn't really make $100,000. I really made only 95 because five of that went to my retirement account. And so I'm only taxed on $95,000. And to do the math on that, that's got to be 19, it's 19,000. So say I'm paying $20,000 in taxes, I only paid $19,000 in taxes. Peanuts. However, it's something, right? The alternative to that is I make $100,000. I still contribute the same 5,000. Oh, let me go back to the traditional IRA. The traditional IRA, I make 100,000. I send five to the traditional IRA. I only are taxed on the 95 because I reduced my income by 5,000 by putting some into the traditional IRA. The 5,000 that I put into my traditional IRA is going to grow over the next 20, 30, until I'm 65. When I take that money out, I'm going to be taxed on the distributions. Okay. So remember a long time ago, we were talking about, we said, one of the ways is you get a big lump sum. And then the idea is that you're going to take the 4% rule. You're going to get, you're going to get a little bit of your nest egg. You're going to start to withdraw and then you get the Social Security. Well, when you start to take that money, let's say you took $5,000 a month in retirement, you're going to be taxed on that $5,000, just like it was a regular income, or regular salary. Okay. In a traditional IRA. In a Roth IRA, it's different. In a Roth IRA, when you make 100,000, let's say for example, and I will be taxed on that. So I have 80,000, 100,000, tax 20%. I have $80,000 left. On the $80,000, I'm then going to go take that money and I'm going to go put some into a Roth IRA. Let's say the same 5,000. That $5,000 is going to grow over the next 10, 20, 30, whatever years until I'm 65. However, when I'm 65, when I get paid $5,000, I get that tax free. Okay. And so the trade-off here is this sort of over analyzing and like, man, you want to like over analyze something, you want people like kind of really geek out. And it might be entertaining for you just to go to like to a certified financial planner or whatever and just kind of like let them geek out over it or whatever and let them give you sort of whatever they think. But the idea here is like, well, if I'm gonna make, let's see if I get this right. If I, if I'm not really making a whole lot now, and let's say my tax bracket's 10%, I'd rather pay my taxes now because in the future, when I'm 65, I'm going to be making $400,000 and my tax bracket is going to be 40%. And so I don't want to take distributions that are taxed later on because that 40% tax on the distributions is a lot more than just getting taxed now at 10%. And sort of the vice versa. If you're in a traditional, might be like, well, I'm really getting taxed now because maybe I'm a physician and I'm getting taxed 40% of my income. And so like any benefit helps. And so I'm going to deduct the traditional IRA income off of my income, and then I'm going to put that into stocks, and then later down the road, I'll pay taxes later down in retirement. But to be honest with you, I'm going to be using the 4% rule, and instead of making $200,000 a year, I'm probably only going to be making $60,000 a year. And the taxes on 200,000 percentage wise is different than the taxes on 60,000 percentage wise. So it makes more beneficial for me to get a tax break now when my bracket is high, and then when I'm later, I'll just get taxes when I'm old and I'm getting whatever, the small amounts, right? And so there's like this little nuances of like, and this is really like a 99%er question, right? Like when I hear people talk and argue about like you should do traditional and then Roth, and then you can take money and you can take it to this, and then you can do this thing called a backdoor Roth, and you can train all these things that people do and manipulate or whatever. It's absolutely silly to me because the wealthy don't pay taxes. We don't pay taxes in the beginning. We don't pay taxes at the end. I mean, we pay tax, but we're going to get more into that. But if I made $100,000 in income and I was able to have a bunch of write-offs, I'll just use that term write-offs. That's not what we're going to be doing, but the write-offs, where my income is zero, doesn't really matter. I'm not paying taxes. And when I take distributions later on and I don't take them as income, or I do take them as income, but then I'm also have write-offs on that income later on in life and I don't pay taxes there either, doesn't matter. It doesn't really matter. I'd rather potentially, I guess, is instead of have a little bit more money now, I guess, by getting a little bit of tax write-off and getting the benefit now and letting that tax saving snowball, then actually pay the tax man for it, as in with the Roth IRA, which is why I've always done traditional. Again, we're not going to geek out on that. The main thing, if you're confused already, the main thing I want you to understand is that when investing, there's this thing called investing in stocks. When you invest in stocks, You can do it basically in two different ways. One is like a traditional retirement account, and the biggest one is an IRA. Within an IRA, there's traditional and Roth. I got to cover it because it's the main one that people do for the 99 percenters that are out there. The other one is a 401k. The 401k, you can contribute like 20, 25 grand a month or a year, sorry. Traditional IRA, you can only do like 60, 600, I think it is, whatever the bracket, it changes every year. So, but if you're a regular employee and you're working for a company, you should be putting money into that. The next way, and I alluded to this a little bit earlier, is buying direct stock. And so, if you're one of these people, and maybe you're on TikTok or X or whatever, and you're like, oh, these people are doing day trading, they're making tons of money, and I know stocks are going to go up, and I want to put money in crypto, whatever. You do you. What most people, most smart financial advisor type CFPs, type just mentors or whatever, would say to somebody, unless you're going to be able to do extensive research on a particular company every week to figure out what's going on, what's moving, what's happening in the industry, whatever, a lot of people just say, throw it in an index fund and chill. Okay. What an index fund is basically a bucket of stocks. Usually the stocks can be like an S&P index fund. VOO is the ticker. VOO is a blanket of the largest companies. So think Tesla, think Coke, think Exxon, think Chase Bank, all the big stocks. And if I put in 10 grand, that 10 grand is evenly distributed over all of them. And I kind of just get a little bit of it, a little bit of each, give or take. If I buy a direct stock, I only own just the stock. If I have one stock and it goes crazy, up or down, could be benefit, could be worse, could be bad. The idea of holding an index fund is you kind of blend amongst all the stocks. You could go and say, well, I'm going to buy 55 of my own stocks I want. That is a way to be diversified. But then again, I would say to you, are you going into and researching? Because if one goes to zero, that could be a problem. Here's a chart. And basically, I hear people all the time like, oh, what should I put in? Should I put in, this index fund over that index fund or this one or that one or whatever? As you can see, when you buy an index fund that tracks a bucket of all the major companies in the major sectors, they kind of all go up together, they all go down together. The market moves together. We won't get into that. It is what it is. You can go into, if you don't want to do an index fund that just does a bucket of stocks, you could go in and say, you know what, I think that cryptocurrency is going to be really good. I want to do a cryptocurrency ETF, which is like going to be an index fund of companies that invest in cryptocurrency type companies or cryptocurrency themselves. You can also do an ETF or like a blended bucket fund of the banking industry or the traveling industry or jets or national defense, or there's like a number of different areas. So if you're like, hey, United States, we're going to go into war. I think that all the defense contractors are going to make a lot of money. I want to go invest in a bunch of defense contractors, but I don't know who to invest in. You can just invest in an EFT that kind of buys a bunch of stocks in that industry. Hopefully that makes sense. You can invest in direct stocks. So let's say you have a 401k, you have a traditional IRA, the max you can contribute is 6,600 for the year, but you want to contribute $30,000 because you got it, right? You can go and buy direct stock through a taxable brokerage account, which means as you buy and sell stock, as you make a profit, you are going to be taxed on that. Or if you lose, you're going to be taxed on that. You can basically have a tax benefit or write off against other gains. Within buying direct stock, okay, what would be recommended by most financial people that are out there in the circles would say, if you're in a traditional IRA, Roth IRA, 401k, whatever, buy an index fund and just let it chill. You don't need to buy and sell out of it. You just kind of contribute your $500 every single month. Just contribute. Wake up 35 years, you're gonna have a nice little nest egg. You'll get an 8 to 10% return. Just let it chill. When you buy funds and taxable brokerage accounts, Most people do that. Again, recommendation would be follow with a retirement account and just buy, you know, regular fund, index fund, and just let it chill. Get your 8 to 10%. However, however, if you want to make a little bit larger returns and you crawl, walk, and probably never, ever run, unless you're, and then being a full-time job at this, you can invest in individual stocks. What I do, in a way of saying that I'm not telling you to go do this, even though I don't do this, but what I do, education purposes, would be, let's say I'm going to put in $70,000 into the stock market. I might put 80% of that into like an index fund, VOO. So just let it go. But because I have this need to satisfy, which we all do, I have this need that I think that I am the greatest stock picker in the entire world, and that I can just outsmart the entire industry. And then I watch so many people on TikTok and on X and making so much money, as they say, that I want to choose stocks. You can then go choose with a small percentage of your portfolio. I want to buy Tesla. I want to buy Bitcoin. I want to buy Nvidia. I want to buy whatever it is. And you might buy that and have it go up, and you might decide to sell it because you're watching the industry based on what you think is happening, whatever. A good example of that is you might say, I'm going to buy Tesla because it's down 30%. And Elon Musk just got an approval for autonomous vehicles. And so now that all the vehicles are going to be robotaxi, I think the company is going to be absolutely crazy. And so I want to buy into this individual stock, even though I own it probably in my index fund. I want to buy it because I like the idea of gambling. I kind of just like the idea of just kind of picking individual stocks because it's fun. Do it. Within that, let me be super clear with you. Within that, people buying Tesla and holding it because they think it's going to putting money in index funds. I'm going to take individual stocks and I want to put in, make myself feel good. Within that, there is a very smaller amount of population that decides to lose all their money. And let me be perfectly clear with you as we go into our next stock trading. There are people out there that decide to lose all of their money because they think, well, they just like gambling, or they just like to lose all their money. Let's talk about day trading. Now, if you have found me and you're watching this particular course, you are most likely have already looked at or know what day trading is. You may have even tried it yourself. Day trading, for those of you that might be new to it, sounds just like it is. It means buying something and selling something in a given day to make a little bit of profit. So an example of that would be it's 8 a.m. Pfizer just got a new drug that they were approved for that cures cancer. At 8 o'clock, before the markets even open, the news comes out and the stock's already going crazy. You know, as a day trader, that everyone's going to want to buy into the new stock. Hedge funds are going to want to buy into it. Retail investors are going to want to buy into it. This thing's going to be going crazy today. Long story short, what a day trader does is try to capture the momentum up or down on a given stock in a given day, sometimes for seconds. Okay. And so what I mean by that is you might go, it's 9:30. Great news came out. Pfizer got a new drug approval. It's 9:30. The bell rings. The stock market's open, and that stock goes from $60 immediately up to $66. For those who can't do the math, that's a 10% increase. And you're like, this thing's going to run 30, 40, sometimes 1,000% up. And you're like, I want to catch that because, and this is what entices people into day trading. Because if I only have a little bit of money and I've never had money and I've seen people in their fancy cars and their fancy watches and their nice homes and their vacations, and they say they do day trading and they just took $1,000 and made it into 10,000, then they took the 10,000 and made it into 55 gazillion dollars. I want to do that. What I'll say to you is that it doesn't happen. Okay. It does not happen. Most of the people that are out there that are telling you that they are making crazy money because they have some special algorithm, they have some special trade thing or whatever, some da da da, and they're just trying to sell you. They make money because they're selling you a course or they're selling you a Discord or they're selling you something to get you, and you pay, $100 a month to join some group that trades or whatever, and they can get 1,000 people to do that. They're making $100,000 a month. That's a 1.2 million a year. Not too bad. And they might be not profitable. They may be trading and not even trading with real money. We'll get to that in a second. However, there are people, and let me be perfectly clear with you, crystal clear. There are people that trade or decide to take on this thing called day trading, and they trade not for a year, not for 5 years, but sometimes a few decades. For those who don't do math, that could be 20 years. And every single day, they trade and they do a little bit and they just kind of dabble down around and down. They do something. They play Fortnite. It's a video game. Okay. Day trading, I want you to fundamentally understand when you buy something and you sell it later and you make a profit, somebody lost money. Some people don't think about that. But if I buy something for $10 and I sold it for 20, yes, somebody bought it for 20, but that $20 stock is probably going to come back down to 15 or probably back down to 10 because there's all this momentum and all this hype. So the stock goes crazy up. But then all the people are buying it just to make a profit. Somebody's caught at the top and it gets sells off and all those people lose money. So as many as people that are making money that particular day, there are people that are losing money. Very, very clear. Day trading is a game. I don't see it any different than that. That said, there are people that are out there that have done it for years and years and years and years, and they've perfected it. Even those people that have perfected it, those that are profitable based on an equation that they've won a little bit more than they have lost. So even the best day traders that are out there are still, up 10,000, down 6, up 8, down 4. Like they're up and down, up and down. And they've learned to let the winners run, and they've learned to cut the losers quickly. They've learned to trade, to understand how everyone else is trading the market, and they almost do opposite of what everyone else is doing. Because when everyone else thinks it's going to go up, it's usually going down. When everyone thinks it's going to go down, it's usually going up. What most day traders do is the stock goes up, it goes up, and it goes up, and it goes up, and they're like, oh my God, it's going up. I got to get into it. And by the time they get into it, it's already too late, and it's already on its way down. And those that had got in early, those that had seen something before because of their 20 years of experience got in early. And so they rode it all the way up. And then they got out once they got profit. And that's when it started to sell off and it went down and it wasn't good. do not do day trading unless you are extremely exceptional at your emotions and do the philosophy crawl, walk, run. In most cases, the best trainers that are out there, how to train you a day trainer. And we're actually going to, hopefully, we're going to have two interviews. They'll be below on our website, medipity.com, of two people that trade two different strategies that consistently make between 5,000. The other group, there's people making 50, 60, $80,000 a day, but they're following a very process that said they've been doing it for 20 years. And so they practice, they practice and practice. One of the things that I'm going to have my kids do, because I think day trading can be such a powerful tool in wealth building, because you can make a couple $100 in a couple of minutes, is I'm going to teach my kids at the age of about 16, once they can understand sort of, the process that's happening. And I'm going to have them practice from 16 to 30. When I say practice, I mean you can actually go and fake day trade with fake money every single day, just like you had real money. I'm going to have them practice it so that they have 10, 15 years experience before they get into it. Because if they can figure it out for the very small 0.000001% that are actually going to do it, and I'm spending a lot of time in this. For those of you who are bored, you can skip through. For those that are kind of interested in day trading, it's very important. 0.0001% that are profitable, it's lights out. I trade from about 9:30 from the bell opens. I usually don't trade right early on. I usually about like 9:45. I let the market settle, pick a direction until about 10:30. So about an hour every single day. And my goal, believe it or not, is to not make several thousands of dollars. My goal actually is just to make a couple $100 a day. While I would love to make hundreds of thousands, even me doing it for so long, I have not necessarily perfected it. But here's me, day trading in this particular setup. This is actually where I'm talking right particular now. It's probably hard to see. I think this day made a couple $100 profit. But and I'll tell you why I do that. If I make $100 a day, just $100 a day, and I can make $100 a day by going buy, sell that quickly. That's how day trading works, right? Just by catching some momentum. If I can just do $100, $200 a day, let's say I can do $2,000 a month. So $100 a day times 20 trading days, because you only trade Monday through Friday. And I took that $2,000, and let's say I did that from the age, 30 to 60. So, or I did it for 50 years, let's say. So I guess that's from 25 to 75. From 20 till 70, I did that. I don't know why I picked 50 years on this graph, but let's say I did for 50 years. That $2,000 every single month compounds to $13.7 million. And so the idea is that if you could figure out how to day trade and just put an extra, $2,000 to $5,000 a month into your retirement account, and you just do it in an index fund and you just let it sit there, and then let the 8 to 10% compounding interest happen, the savings that you have is absolutely incredible. And so this is what I do every single day. And if you're following me on any of the social medias, you'll see me do it. Full disclosure, I am with a group that I've joined. I don't run the group. I'm not a part of it. They don't even know who I am. I don't think they even know that I'm in there necessarily, because there's a bunch of us. And it's a group that just is there for the sole purpose of, nobody says buy this, buy that, whatever. There's tons of training what you should be doing, but it's a group that just literally calls out things that are happening in the market. Like they might say, hey, Tesla's up a bunch all of a sudden for some reason. Hey, Nvidia's just dropped. Hey, Facebook is doing this, whatever. And they just call it different stocks so that you can independently go in there and decide if you want to go and move with it. They don't call when to buy, when to sell, none of that, none of that, none of that. If you get a group that does, God, run from those people, because those people are buying in and they're telling you to buy in so that they can make money off you. And I do that for two reasons. One, because I make this little bit of money and I actually take that money and I do go put it into, I take the profits that I make and I put it into long-term investments, and I just do that. I'm just kind of like funding a longer-term return investment, a longer-term, stock account. So I kind of day trade for fun money. I always say because I was never able to play video games when I was a kid, so this is my way to just to kind of play around. I have that sort of need or drug in my body that's like I just want to go trade up and down, up and down, up and down. It's just interesting to me. And I would love to get really, really good with the guys that I go trade with that are making 50, 60, $60,000 a day. There's some guys right now as of it's January let's see, it's the 15th, and people are in there making have made almost $1 million so far in just a couple of trading days. Pretty crazy. So if I can get to that, how powerful would that be? Even me and not done it for 7 years, still not there 100%. So you never want to follow me. But that is me trading, and I do it for taking that little bit of money. And I also do something is I take that money and I use that to buy my supercars that I drive around. A supercar payment is going to be about 2 grand or so. And so I can make a couple $100 a day and that can pay for the supercar. We're going to leave it at that for stock. Then we're going to go into the next video and we're going to talk about business and we're going to talk about private businesses. That needs its own video. As long as this one is, that one is going to be just as long, talking about private business. For those of you go down who are watching this on YouTube, please go to mundipity.com where we have all kinds of extra bonus content. I'm going to post on the page where this video is, hopefully 2 interviews. If not, I'm just going to give you 2 examples of people day trading, and I just want you to see it for themselves. And one is a momentum trader, and I'll put a picture of myself in there. Actually, just kind of funny today, I was trading. I'll show you. I don't know if the camera was going to pick it up. Let's see. The camera picks it up. Down here at the bottom, you'll see. I don't know if you can see that there, but today's profit was $5,000, or $4,950 is what the profit was today. So the idea is that I'm going to show you a couple examples of me trading so you can see how I do that. And just how easy it is. I'm not going into anything like how to do it or whatever. I just want to show you that it does. And I'm going to show you Momentum Trader that I think he posted 17,000. And if I can get those guys to do interviews, hopefully I get enough traction with the course. I get those guys to interviews. I want to see if I can get an interview with them so they can come in and talk to them about how their groups, how their training method works. I'm not sponsoring either one of those. I'm not getting paid by either one of those. I'm not recommending either one of those or endorsing any one of those. But I do, for those of you who do want to give, or for those that are interested in day trading, you need to learn it from somebody who is legit. I've been out there for 7 years or so. There's 2 guys that I think are absolutely legit, very, really good, kind-hearted people, not necessarily there to take your money or scam you, or they're not there just to pump and dump stocks. They're just literally there to support and to train and to help you out. If I can get those 2 guys, I'll list them below. If I can get them to interview, great. That'll be below, and I'll put a couple of videos of just them trading at a minimum for those that are interested. And so this is, if you're on YouTube or you're one of those other places, if you go to mundipity.com, we have a lot of stuff on our website within the community of extras, whether it be extra interviews or different places of, hey, you should read this book or you want to expand on this particular topic. This is going to be the first one. Again, remember I said we're 10,000 feet and we're talking about, the mindset and credit and leverage and then earning and then investing in taxes, but then we can't go into each and granular detail. I would love to teach you how to do day trading, but you're better to hear from an expert. And I can't go into that because their courses are like eight weeks, 6 months or whatever. If day trading is something that you'd be interested in, by all means, you can go and pursue them, someone else or whatever, but this would be the first area of saying, hey, I might want to be interested in this. It'll make more sense once we wrap up the entire course later, and how that could be useful, but there it is. Until next time, we are going to be talking still about how to invest, but that with private business. Until next time.